So, did you hear about Warren Buffett's latest investment? So, investors have been speculating about what mystery stock Buffett moved into since late last year. And just yesterday, they announced the stock. It's now his ninth largest holding, at least at the end of March. The stock scratches two itches for Buffett: insurance and what he calls equity bonds. So, these are stocks that pay a dividend that increases consistently over time. One of those companies is Chubb. So that's the insurance firm that Warren Buffett made an investment into. Chubb is one of 84 dividend champions we cover here at Nanalyze. So they've increased their dividend for 31 years in a row. So the company that we're going to talk about today isn't Chubb, but it's what they call a dividend king, which means it's increased the dividend for at least 50 years. And in the case of today's company, that's 59 years. So to put this into perspective, they've been increasing their dividend for as long as these individuals have been alive. So before we talk about that company, I had a question. If you've been invested in the stock market for 30 years, then how much money can you expect to have? Would that be 2 times more, 3 times more, 5 times more? So let's answer that question. And let's just talk simple price return, what most investors understand intuitively, which is you buy a stock for a certain price and you sell it for a higher price and then you realize a profit. So Yahoo Finance is a quick and dirty look at price return, and we can do that for the S&P 500, and it comes in around 1,057%. And what we can then do is validate this against a tool that then lets us take not only just the price return, but also we can take into account dividend return, and we can reinvest those dividends. So we do that here with this calculator. You see the total S&P 500 return of 1,058%. That meshes with Yahoo, so we've double-checked the numbers there. Then they take the dividends over the past 30 years, reinvest them, and then you get 1,900%. So this return is meshing well with the 9 to 10% return we expect from the market. So that'd be around 6.6% inflation adjusted. We use that all the time. And when people think about the S&P 500, they need to make sure that they use the total return, which is taking into account at least the price return of the S&P over time and also the dividends, whether or not they're reinvested. You'll get two different returns for that. So here you can see the yield of the S&P 500 over time. So it's quite low right now. You can see where it's spiked during recessions. So the company we're going to talk about today is Illinois Tool Works, and you can see it listed alongside Parker Hannifin. So we did a piece here on Parker. They're a dividend king as well. And these are two very high-ranked companies in our Quantigens dividend growth strategy. Here you can see the industrials sector that has the most companies of any sector, around 19. And up there at the top, you see ITW and Parker Hannifin. So how well did ITW perform? Well, if you picked a stock from the S&P 500 and held it for 30 years, you should have, and this is referring to price return, you should have returned at least 1,060%, roughly, right? If you matched that return, you didn't do well at all. Why? Because you took on a lot of company-specific risk that you weren't compensated for. So you could have just held the entire index and made 1,060%, but instead you picked a stock and made the same. So the risk-return ratio there is out of whack. But if you picked Illinois Tool Works and it returned 2,340% over the past 30 years, you would have done quite well for yourself. Boring old Illinois Tool Works managed to do that. So what you got was a NASDAQ-sized price return growth with the benefits of an equity bond value. Now, you may say, well, 2,340% is different from what I saw on the thumbnail, which was 2,700%, and you'd be absolutely right. So here you can see Illinois Tool Works against NASDAQ. So they didn't quite outperform NASDAQ, and that's expected because you're not invested in growth stock, you're invested in a value stock. So the S&P 500 is a more appropriate benchmark. But in fact, Illinois Toolworks did beat the NASDAQ. So let's talk about why. So when we think about returns, as I said, you have this idea of buying a stock and selling it for more than you bought it for, right? It's capital gains. But during the time you owned that stock, you may have had any number of corporate events affect returns. These can be very complicated. So some examples would be dividends, special dividends, spin-offs, stock splits. When I worked at MSCI, we had an entire team behind the wall that would evaluate corporate events, often taking some time to really sift through the data. Now, when we look at returns, most return tools adjust for stock splits to make things easy. But when we calculate return, we don't want to just think about the price return we've been talking about. We want to add in the dividend component. That's called total return. And calculating total return sounds a lot easier than it actually is. So we're just going to do some simple math. Let's take the current price, divide that by the return over 30 years to get the share price 30 years ago. That's $10.63. Okay. Now let's calculate the yield back then, because if you go to Illinois Toolworks website, they provide you with all their dividend data. So the yield back then was 1.27%. Now, when we did our Parker Hannifin piece, lots of people were complaining about that low yield and didn't seem to understand how effective a yield becomes when it's growing over time. So remember, that yield has increased over time based on 30 years of dividend increases at least. They've actually increased for 59 years. But in 2023, the dividend for Illinois Toolworks was $5.33. Okay, so roughly, let's say, the same this year. So what that means is that you're receiving your original invested capital back every 2 years. That's crazy, right? So let's go back to calculating that total return. I bought one share at $10.63. That share today is worth $248.63. So I received $49.18 worth of dividends over that time, which I spent on good things. So I invested $10.63 and received $297.81. So that's the capital gains on the share price and then the dividends. So I'm actually up 2,702%. Not only that, but every 2 years, I'm going to receive at least my original investment back because that dividend is presumably going to continue growing. That's what the company says their goal, one of their financial goals is. So life is quite good. Now, imagine the growth of that stock if you were responsible and reinvested dividends instead of spending them. So that's what they refer to as the snowball effect. And we've been invested in Illinois Toolworks for quite a while and have used that drip effect to compound those returns over time. And we haven't been invested for 30 years, but a fair amount of time. And here you can see all the dividends paid by Illinois Toolworks and the increases over the past 30 years. So since we know the share price compound annual growth, we can assume that growth is linear and then at the end of the year take the dividends and buy a fractional share. So we calculated that out. You'd have an additional 0.72 shares. So the snowball effect would have then brought your total return for Illinois Toolworks up to 4,386% over 30 years. That's quite remarkable. So one of the big takeaways from today's presentation is just understanding that there's a variety of returns. So at MSCI, we'd have clients asking a lot of questions about how we calculated return. And price return, as I've been talking to that throughout the entire presentation, is really the price performance of the index or stock. It excludes the value of regular dividends, but you see it says here that it includes special dividends. So if you're looking at price return, you want to make sure that it's actually doing that on the back end. Then you have gross total return. So now you've added in the value of all dividends, both special and regular. All right, that's your gross. Then net, what they do is they actually apply an assumed foreign tax withholding rate. So you see how this stuff can get quite complicated in a hurry. But gross total return, what we've looked at today for Illinois Toolworks, plus that value with dividends reinvested, is always what you want to consider when you're looking at dividend stocks. So let's talk about Illinois Toolworks briefly. This money-generating machine, you can see here, as with Parker Hannifin, they have very clearly stated performance goals. One of those is to increase their annual dividend by 7%. I think they've been doing that in the last 4 or 5 years now. They refer to themselves as having a diversified, high-quality business portfolio, and that's what we love. Here you can see the various things they do, from welding to food equipment to automotive. So automotive makes up 20% of their total revenues. They brought in $16 billion in 2023. They make it a point to advertise how innovative they are with their 19,600 patent portfolio. We usually don't pay much attention to that, but I guess in terms of rankings, they're supposed to be a fairly innovative company, certainly financially prudent. And when we look at last quarter, I thought this was interesting. Their investor decks are very simple, easy to thumb through. When you hold shares of a quality company like this, you don't find yourself checking things very often. You just assume they're getting the job done and executing. But here you can see organic growth by geography. Look at China coming in at 15%, at 7% ex automotive. And then on the right there, they show their automotive OEM revenues and operating margin. You can see China 23% growth. This goes to talking about how the Chinese automotive industry has been just on an absolute tear. We've covered that a lot in recent videos and articles. So it's nice to see one of our dividend champions getting some exposure to the growth of automotive in China. So just some final comments here. Understanding return is very important. What we refer to as total return, which is price return plus dividends received, is probably for dividend growth investors the most important thing to consider. Then, of course, you can look at total return with dividends reinvested, turning on your drips, and then to calculate those. Discounting stocks with low yields is a big mistake. We saw that with Parker Hannifin. We continue to see that going forward. I think today's presentation demonstrates just how valuable dividend growth is as opposed to just paying attention to current yield. It's extremely powerful. You can think the example of Buffett and Coca-Cola. I think the last thing to conclude today is that boring businesses can be anything but when it comes to the total return they provide your portfolio over time. So I'm going to go ahead and leave you with another video here that you might find interesting, which looks at a handful of great dividend stocks. Before you watch that, please make sure to subscribe to this channel, support our work. Thanks so much for taking the time to watch this today.